Welcome to today's August 24 Market Digest. Equity markets experienced a clear sector divide today as investor focus shifted toward a major liquidity proposal from the U.S. Treasury alongside an accelerating pullback in high-flying technology shares. The Nasdaq Composite declined for a seventh consecutive trading session, falling 0.8%, while the Philadelphia Semiconductor Index dropped 3%. Concurrently, capital rotated into value and defensive sectors, boosting the Dow Jones Industrial Average by 140 points. Anchoring today's liquidity narrative, U.S. Treasury Secretary Scott Bessent outlined a proposal to deploy up to $1 trillion from the Treasury General Account to fund expanded long-term bond buybacks. This initiative represents a significant scaling beyond initial $4 billion pilot purchases. By redirecting dormant Treasury reserves to purchase longer-duration debt, the Treasury aims to cap benchmark 10-year and 30-year yields near 5.3%, ahead of upcoming Federal Reserve communications at Jackson Hole. Financial market analysts view the proposed TGA deployment as a form of fiscal quantitative easing. By purchasing long-duration bonds from commercial banks and institutional investors, the Treasury effectively reinjects cash directly into active circulation. Data from the St. Louis Federal Reserve shows U.S. M2 money supply turning upward to reach a fresh all-time high, creating a liquidity counterweight to the central bank's ongoing balance sheet runoff. While macro liquidity measures develop, equity price action highlights ongoing sector distribution. The Nasdaq Composite's 7-day losing streak reflects profit-taking in high-valuation semiconductor names following a multi-month rally. Analysts from Investors Business Daily noted that liquidity is rotating away from crowded tech momentum toward consumer cyclical and value sectors, including restaurant operators, retail chains, and leisure travel booking platforms. Adding tactical friction to market sentiment, trade negotiations between the United States and Canada broke down, prompting the immediate implementation of 50% tariffs on approximately $20 billion of Canadian imports. In response, Canadian officials announced matching retaliatory tariffs scheduled to take effect next month. Analysts note that heightened trade friction introduces supply chain cost pressures, particularly across industrial inputs and cross-border auto manufacturing networks. Geopolitical risks also surfaced as the U.S. Treasury Department announced expanded economic sanctions targeting Iranian financial networks. The measure focuses on digital asset transfers, technology procurement, gold trading, aviation, and maritime shipping. Market participants monitored energy markets closely, as tighter restrictions on Middle Eastern maritime logistics introduced incremental supply premiums for global crude benchmarks. Turning to corporate fundamentals, institutional analysis highlights an impending repricing cycle across cloud hyperscalers. As legacy multi-year enterprise contracts expire, cloud providers are renewing agreements at significantly higher spot prices for AI compute capacity. This structural repricing is expected to drive substantial free cash flow expansion for major cloud platforms, providing fundamental support as markets prepare for Nvidia's quarterly earnings release. In consumer equities, fundamental strength remains evident in high-efficiency retail models. Walmart continues to attract valuation re-rating driven by high-margin digital advertising services and membership growth. Simultaneously, specialized footwear manufacturer On Holding posted over 20% direct-to-consumer sales growth, capturing market share from legacy competitors and demonstrating brand pricing power amid broader consumer selectivity. In the fixed income market, 30-year Treasury real yields are approaching 3%, while long-term inflation expectations remain anchored between 1.5 and 2.5%. A key factor driving real yields higher is heavy corporate bond issuance, with major technology corporations issuing an estimated $1.75 trillion in debt this year to finance AI infrastructure. This increased credit supply competes directly with Treasury auctions for institutional capital. This credit market dynamic signals a structural shift in technology capital allocation. Historically, mega-cap tech companies operated as self-funding equity buyback engines, benefiting from zero-interest rate environments. Today, heavy capital expenditure requirements for data centers and custom silicon have turned several tech leaders into active bond market issuers, exposing equity valuations to discount rate sensitivity as real interest rates rise. Looking at global technology valuations, independent analysis from Invest with Sven Carlin highlights a widening multiple disparity between Asian tech leaders and Western hyperscalers.
Tencent currently trades at 15 times earnings, while investing 28 billion renminbi annually in AI infrastructure. This conservative valuation offers an 8 to 9% projected annual return baseline, contrasting with higher forward multiples assigned to U.S. megacaps.
Physical infrastructure constraints are also coming to the forefront of AI deployment. Reports from trade commentary highlight growing local opposition and electrical grid bottlenecks surrounding large-scale data center builds across several U.S. regions. Regional power availability and utility interconnection timelines are emerging as primary operational determinants for cloud expansion speed. In summary, today's market reflects a transition phase as investors balance Treasury liquidity intervention against tech valuation adjustments. Key items to track this week include final details on the Treasury's TGA buyback execution, second quarter earnings from Nvidia on Wednesday, and Chairman Warsh's policy remarks at Jackson Hole on Friday. Maintaining disciplined valuation entry points and monitoring 10-year Treasury yields near 5% remains central for portfolio positioning.